When did the Latin American debt crisis disrupt finance? Have you ever wondered how a financial crisis can ripple across an entire region? The Latin American debt crisis is a prime example of this phenomenon. It all began in the early 1980s, with a significant turning point occurring in August 1982. That was when Mexico announced it could no longer manage its foreign debt, which was around $80 billion. This announcement sent shockwaves through the financial world, triggering a widespread crisis. As Mexico's situation unfolded, many other Latin American countries found themselves in similar predicaments. This led to a sudden halt in new lending from commercial banks, and many countries faced demands for immediate loan repayments. The crisis quickly spread, affecting 16 countries and plunging the region into what is now referred to as the lost decade. This term highlights the prolonged economic stagnation and recession that followed. Before this crisis, Latin American nations had borrowed extensively during the 1970s, taking advantage of low real interest rates and a booming global economy. However, by the late 1970s and early 1980s, the global economic landscape shifted dramatically. To combat rising inflation, the United States and other developed nations tightened their monetary policies, leading to a sharp increase in nominal interest rates. This made it much more difficult for Latin American countries to service their debts. Additionally, an oil price shock raised costs for many oil-importing nations in the region. These factors combined to create an unsustainable debt burden. Commercial banks began to shorten loan repayment periods and raise interest rates, adding to the pressure on these countries. The immediate disruption in finance was severe. Banks refused to roll over short-term loans, forcing countries to repay billions of dollars all at once. This sudden stop in financing resulted in harsh recessions, currency devaluations, and austerity measures imposed by the International Monetary Fund. The International Monetary Fund's involvement included restructuring payments and demanding fiscal discipline, but the economic growth remained weak throughout the 1980s. This crisis revealed vulnerabilities in the region's economic policies, such as heavy reliance on foreign borrowing and high domestic consumption. The financial turmoil prompted Latin American countries to rethink their economic strategies. They began implementing reforms focused on debt, restructuring, and market liberalization. One notable reform was the Brady Plan in the late 1980s, which aimed to provide a framework for debt relief. These changes laid the groundwork for eventual economic recovery in the 1990s, although the social and economic costs were significant. In essence, the Latin American debt crisis disrupted finance starting in 1982 when Mexico's default announcement triggered a regional panic. The crisis was fueled by rising global interest rates and unsustainable borrowing practices, leading to a decade of economic hardship. This episode serves as a critical example of how external shocks can destabilize entire regions.